All right, let's just get right into it. Have you ever looked at the stock market's performance? You see those big, impressive numbers, and then you glance over at your own investment account and you just feel kind of let down. You get this nagging feeling that your returns just aren't keeping up. Well, I'm here to tell you it's not just a feeling. It's a real, documented thing, and we're about to break down exactly why it happens.
So let's start with a number that should really make you pause. Morgan Stanley highlighted a study that looked at a 30-year period. If you had put $100,000 into a simple, balanced portfolio and just didn't touch it, it would have grown to over $1.2 million. But the average investor? That same $100,000 only turned into about $405,000.
I mean, that is a staggering difference. We're talking about over $840,000 that just went poof. It didn't get wiped out in a single market crash. It wasn't just eaten up by fees. So the big question is, where did it go? And that's the mystery we are going to solve right now.
To find the number one culprit, we don't need to go pointing fingers at Wall Street or trying to understand some complex algorithm. Nope. We just need to look in the mirror. Because so often, the single biggest drag on your returns is you. And this brings us to this really fascinating field called behavioral finance. It's all built on a pretty simple idea. Even when we have all the right information, our brains are just hardwired with these glitches, these emotional shortcuts called biases, and they cause us to make totally irrational decisions with our money, especially when we're feeling stressed out.
Now, there are a ton of these biases, but for today, we're going to zero in on 3 of the most powerful and honestly destructive ones that are constantly messing with your portfolio: loss aversion, overconfidence, and the good old herd mentality. First up is loss aversion. And put simply, it means we hate losing way more than we enjoy winning. This is a survival instinct that's baked deep into our DNA. That fear of losing money can get so powerful that it pushes us to sell at the absolute worst time, right in the middle of a downturn, just to make the pain stop. And what's wild is that this isn't just a vague feeling. Researchers like Daniel Kahneman and Amos Tversky actually put a number on it. They found that the psychological sting of a loss is about twice as powerful as the pleasure you get from an equal gain. Seriously, think about that. Losing $100 feels twice as bad as finding $100 feels good. Okay, next up, overconfidence bias. This is that little voice in your head that whispers, "Hey, I got this. I'm smarter than the average bear. I can pick the winning stocks. I know what the market's going to do next." It's this deep-seated belief that we can somehow outsmart a system that is, by its very nature, completely unpredictable. And the biggest danger of being overconfident, just like this quote says, is that it tricks us into thinking we can time the market, that we can jump in and out at the perfect moments. But study after study shows that we are terrible at this. In fact, one report found that investors guess right only about 25% of the time. We end up missing the best days and selling right before a big rebound. And finally, we have the herd mentality. You know this one. It's our powerful instinct to just do what everyone else is doing. When the market's going crazy and everyone's making money, that fear of missing out, FOMO, kicks in and we pile in, usually right near the top. And when the market tanks, seeing everyone else panic sell triggers our own fear, and we join the stampede right for the exit, selling at the bottom. So it's pretty clear our brains are working against us. But believe it or not, that's only half the story. There is another, much more subtle force that's eating away at your wealth. And this one has nothing to do with feelings. It's just cold, hard math. This force is called volatility drag. It's kind of a weird concept, but it basically shows that the simple ups and downs of the market, the volatility, actually reduce your long-term returns. The path your money takes really matters. A smooth, steady ride is always going to be mathematically better than a wild roller coaster, even if they have the same average return on paper. And this reveals something really important about how losses and gains work. Let's do the math. If you have $100 and it drops 20%, you're left with $80. Now, if you gain 20% on that $80, you only get back to 96. To get all the way back to your original 100, you don't need a 20% gain. You need a 25% gain. And as you can see from this chart, that gap just gets wider and wider, and it gets scary fast. The losses, they're in blue, they go down in a straight line. But the gains you need just to break even, in green, they shoot up exponentially. A 50% loss means you need a 100% gain just to get back to where you started. The deeper the hole you dig, the harder it is to climb out. Let's look at how this plays out in the real world. Here are 3 different portfolios. Now look at the bottom line. They all have the exact same average arithmetic return of 8%. But now look at the actual ending values. The smooth one with no volatility ends at $216. The really volatile one, it only ends up at $181. What happened? Volatility drag. Those big swings literally ate away at the real compounded return, which is the only return that actually counts. So now, this is where it all comes together in the worst way. What happens when you combine our flawed, emotional human brains with this brutal, unforgiving math? Well, you get a nasty feedback loop that can absolutely devastate your long-term wealth.
Right. Our biases make us sell after big drops, which locks in the very losses that are so mathematically difficult to recover from. And our overconfidence tempts us to chase high volatility stuff, where the drag is the worst, because we think, I can time it perfectly. It's just a perfect storm for underperformance.
A really powerful example of this is in products like leveraged ETFs. These things are built to juice up daily returns. So in a 2x fund, a 20% drop in the market doesn't just feel twice as bad, it becomes a 40% loss in your position. And as we just saw with the math, clawing your way back from a 40% hole requires a staggering 67% gain.
This is exactly why you see warnings like this one plastered all over them. The companies that issue them are telling you straight up, these are not for long-term investing. They're short-term trading tools, where that volatility drag, sometimes called volatility decay, can be incredibly destructive.
Okay, so we've laid out the problem. It seems like our own brains and the basic math of markets are stacked against us. But it's not hopeless, I promise. The key is to completely shift your focus. Stop trying to beat the market and start focusing on not beating yourself. It's all about winning the inner game. But before we get to the solutions, I want to show you one last powerful image of what is really at stake here. Because the cost of making these behavioral mistakes isn't some abstract idea. It's real money. And as we know, it compounds over time. And here it is. Over 20 years, a simple buy and hold strategy would have turned 100 grand into more than $717,000. But the average investor, who got tossed around by fear and greed and bad timing, ended up with less than half of that. This chart right here is the real long-term price tag of those self-inflicted wounds. So how do we fight back? How do we win that inner game? It really comes down to a few simple, almost boring defensive moves. First, you diversify your portfolio. This is the best tool we have to smooth out the ride and reduce that mathematical drag. Second, you rebalance regularly. This forces discipline on you. It makes you sell a little of what's gone up and buy a little of what's gone down, which is the exact opposite of what your gut tells you to do. And finally, you manage your taxes, because taxes are just another hidden form of drag that can eat away at your returns. Ultimately, what this all really comes down to is a fundamental shift in how you see things. We love to think of investing as this epic battle against the market. But all the data, all the evidence, it shows the real fight, the one that truly decides whether you succeed or fail, is the one you have every single day with the person staring back at you in the mirror.